Go ahead. You're recording now, Gail.
Hey, good evening, everyone, and welcome to another episode of the Good Deeds Note Investing Podcast. I am here once again, Gail Anthony Greenberg, with my lovely co-host, Christopher Seveny.
Hello, all.
Hello. We've spared you all our fumbling with the technical problems here, but I'm glad we persisted because we're joined now by the lovely Beth Boisseau-Coots from J.B. Lloyd Insurance. How are you, Beth?
I'm good. How are you?
Very well. Beth is someone we've been trying to get on our show for a long time. She's a very, very busy person. I guess not just because there's a lot of natural disasters going on all the time, it seems, but you just moved recently, right?
Yes, we are now residents of Austin, Texas.
Wow. So, yeah, Dallas to Austin. How are you settling in?
Pretty well. We're navigating the boxes. So, yeah, moving is horrible.
Oh my gosh. I've been living in my house for 30 years. I've vowed I will die in this house so that my children have to deal with everything.
Yeah, it's worth it. Yeah.
Perfect revenge.
Yes. Oh, yeah. Yeah. I didn't know we had so much stuff. We've been in the house for 13 years and man.
Oh, that's nothing.
It's nothing, but it's a lot of stuff.
I usually don't open the boxes for the first 13 years, so convenient to just move them on to the next place.
Shuffle, yeah.
Absolutely.
Good plan.
Right, so we asked Beth to prepare a little bit, and you were kind enough to say that you have a list in mind already of the most frequently asked questions that you get from note investors. Tell me, first of all, how much of your business is note investors as opposed to other kinds of investors or just regular people?
So that's a really good question. So J.B. Lloyd and Associates, we traditionally specialized in the insurance for financial institutions. And now I would say the breakdown is about 50-50 for me personally, between the banks and real estate investors. And it's kind of interesting how we got involved with it. On the bank side, there's two sides of the house. There's the professional lines, and then there's the lending side. And the lending side, they obviously need lender-placed insurance. So during the Great Recession, the banks were offloading great giant pools of distressed assets, and real estate investors were born. Not really, but and they were buying them. So I was getting calls because people needed an insurance policy similar to the lender-placed form. And so that was kind of how I fell into this. And over the years, we've just adapted. As your space has grown, we've tried to be responsive and grow with it. And we've adapted the form to be a little bit more customized for the real estate investor. So anyway, that's a long answer to your question, but I would say about 50-50.
You look like you're about to say something, Chris.
No.
This is the problem with video. There are visual cues.
No.
I know. Don't let me forget I'm on video.
No, you look lovely after a long day.
Well,
I'm just attempting to text my husband to tell him to bring a fan because it is like stifling in here. You guys talk amongst yourself. Actually, Beth just revealed something that I have never heard. You actually are the heiress of the J.B. Lloyd family.
Well, heiress sounds kind of fancy, but I am Jim's daughter, J.B. Lloyd. He is my father. We laugh in this business. Nobody sets out thinking, hey, I'm going to grow up and be an insurance agent. So most of us who are in the business became part of the business because of a parent or a family member. So I started doing this 13 years ago in March, and I really, really love it. If you had told me as a teenager that I would say that or even be in this business, I would have laughed at you. But it's always interesting, and there's always a challenge, and there's always something to learn. So
yeah. What did you think you were going to do when you were growing up?
Well, I majored in art, and I actually had an art business for many years. And then I had a change of life and decided to do something different. Went into sales. My father saw that I could be a good advisor to people, and hired me away. So that's how I landed in the insurance business.
Oh, wow.
And I tell you what, it's been wonderful. It's been the most challenging thing I've done, but I think that's why I have never gotten bored with it. And I get to work with great people. That's the best part of it.
Yeah. Well, I have to say you are very easy to talk to, and you're very good about explaining things, because I have had a fair number of brushes with insurance claims, and I still don't totally understand everything, what I own, like what's going to happen. So I'm really glad you're here, because I have as many questions as people who are newer to this.
Nobody knows a lot about insurance if you're not in it. I mean, it's like eating cardboard, reading the policy. It's necessary, it's important, but it's
yeah, that policy is like, what is it, 200 pages long? It's really long.
Sometimes. Yeah.
Yeah.
Yeah, and most of the information really can be found on the declarations page. So if you do nothing else, read the declarations page.
I was hoping you were going to say that.
Yes. Yeah.
Why don't we jump in? You had said you could share with us what the most common questions that note investors are asking you, and I'm curious to hear what they are.
Well, there's quite a few, right? And it kind of varies. One of the biggest questions I get is, what's covered? What do I have? What is this? But even, let me back up a little bit further. People want to know, what is real estate investor insurance? There's a lot of confusion. People will say, use the term lender-placed or force-placed insurance interchangeably with real estate investor insurance. And there is a difference. The main difference is that real estate investor insurance is,
people can see you. Those are shorts. That's not underwear.
I'm gonna ask. Looks good to me. Real estate investor insurance is a little different than force-placed insurance. There's a lot that's similar in terms of, in their traditional form, both are master policies, which will allow the insured to add properties or assets as needed. Both will allow, in most cases, the insured to pay monthly and only pay for what they use. But the biggest difference is that a real estate investor policy will have liability coverage on all assets, regardless of the status of the property, whereas a lender-placed or force-placed policy is only going to cover liability on foreclosed properties. So that is probably the main difference. The other one is that a real estate investor policy will have a co-insurance penalty built in. And we can circle back to and dive a little deeper into what co-insurance means a little bit later. But just kind of in a nutshell, that's the difference between the two policies. They're very, very similar. And a lot of y'all use the terms interchangeably, but there is a distinct difference. And the main one is the liability.
Oh, okay, so wait, this already, and I'm sorry, I was plugging in the fan. Lender-placed and force-placed is where the liability difference is?
Lender-placed and force-placed are the same thing.
Okay.
And that really is, that's an insurance policy that lenders and banks that lend on real estate will have.
Okay.
It's very similar to a real estate investor policy. But there are some key differences, and the main one is the liability coverage. Liability coverage is included, unless an insured opts out, it's included on all of the properties a real estate investor has. Whereas,
okay, so is liability missing from one of those?
On a bank policy, on the forced place policy, liability coverage is only included on foreclosed properties.
Which...
Okay, good.
I was going to say two things that struck in my mind that you mentioned, and one of the things I really like about J.B. Lloyd that you hit upon. One is you can pay monthly on your policies with you, where other firms charge you for the full year. So if you're investing $100,000 property, that policy may be, call it, $1,100, $1,200 a year, where with your program, we can pay monthly. Every other program, you're going to pay the $1,200 out. And that's one thing. The other thing kind of you touched upon is like the forced place for sure insurance. And this is for a lot of listeners. When I use my servicer, I ask that question about liability and stuff. And sometimes they say, well, it's not liability, but also once you foreclose and take the property, they say that policy's canceled and you have to go get it somewhere else because they're not servicing it anymore. So those are two things I just wanted to mention to people who may use a servicer or that lender place to get their insurance to be careful of. I don't know if you want to talk more about that or have any other comments.
Yeah, I'm actually curious. So I have many contracts for deed, and I think our listeners do as well. So we actually own those houses. They're deeded in our names and our entity names. Do those not have, if they have borrowers in them, do they not have liability?
No, they do.
They do.
They do if it's a real estate investor policy. The reason it's set up this way and that it's evolved to be this versus the forced place is because a real estate investor has any number of types of investments. And sometimes, somebody will specialize in one area or another, but oftentimes you'll find an investor will have some contract for deeds. They'll have some buy and holds. Maybe they'll do a few fix and flips, and maybe they're acting as a private lender just outright to, a long-term tenant or something. So you've got a lot of different types of things going on in some cases, all of which the investor has an insurable interest. But it's not as cut and dry. Whereas a forced place policy is speaking to a bank's need simply to cover their interest in a property should the borrower let their insurance policy lapse, or in that case, the borrower would still be having all the exposure for the liability should there be a liability claim. Whether they have insurance or not, the exposure is still on them, not the bank. Now, once the bank forecloses, that shifts and the exposure is on the bank. So that's why the forced place is set up that way. Whereas with a real estate investor, you have the exposure all the way around. If you're a landlord, you have the exposure. You're on the deed, you own that property, you have some sort of peril that causes a kid to, cut their hand off or whatever. You still have that exposure. If it's a contract for deed, even if you've got a contract in place with your borrower or the homeowner, or, I'm not sure the term you would use for that person. But you're on the deed. So you still have that tie to the property. On a fix and flip, it's the same thing. So there's a liability exposure in really any of the scenarios you can think of as a real estate investor, whereas a bank or a lender, a traditional lender, doesn't have that same type of exposure. So that's the reason for the difference on that.
Okay. I don't want to miss anyone's questions. We'll just keep rolling. Chris and I were actually discussing the other day, like at what point you actually have an insurable interest in a property, because, the classic scenario for us as note buyers and contract for deed buyers is that, we pay the money and then there's usually like a wait of, a couple of weeks to even a few months before we get the deed and the transfer documents to us. So what is going on during that time? Do we have an insurable, at what point do we have an insurable interest on a contract for deed?
As soon as the contract is signed. So
our purchase contract for the asset.
Yes. So even while in that interim, you're waiting for the deed, you still have that insurable interest because that contract is complete.
Right, as long as we go on the portal and actually put the property in. I bought 12 today, so excuse me, I'm just going to go get on J.B. Lloyd.
Yeah, I had an oh shit moment on that, and that's when I emailed you. I'm like, oh man, when does that occur? Because I'm thinking if that waits till the deed, I'm like, I am in this big limbo because and I was actually talking to Gail about, I do, you do an inspection on a property, you do a BPO on the property, but you don't close till like a week later. And one of the things I mentioned, Gail, is I'm like, in a lot of these contracts, it doesn't say that the seller is going to keep insurance on the property till the sale date. So I'm like, you may want to talk about that, because we look at it, today's June 6th, but I may have looked at the property 2 weeks ago and I'm closing on it today, and there's that 2-week lapse. And then I'm like, then there's that month of before it gets recorded. So that's why we ponied up that question.
I wondered if there was some conversation, because I think I got it from both of you guys.
Yes, there was.
We were racing to see who could get the answer from you first.
I saw panic between
They're definitely panic. I actually had another version of that, because I famously bought a church at a commissioner's sale. Basically there's a long period of time where you've paid the money. I went to an auction, so a commissioner's sale, for people who have not experienced the wonder of it. I don't know if every state does this. This is in Indiana, but first there's a tax sale. Everybody has tax sales. But then if you've ever wondered what happens to all the properties that don't sell at tax sale because they have like ridiculous taxes on them that are way more than the property is worth, they get bumped to another sale. And in Indiana, the tax sale's in the fall, and then in this particular county, it was January that the commissioner's sale happened. So once you buy at auction the property and pay the money to the county, then there's a 4-month redemption period. And after that's over, then there's you apply for the deed, and the court can take up to 2 months to give it to you. So there are 6 months where you're just you've paid a bunch of money, but I wasn't really sure that I had an insurable interest yet. But I guess as soon as you've paid money, you have an insurable interest. Is that?
Yes, as long as you've got something to prove that you have paid the money, then yes, your insurable interest starts there.
Right, and then can we only get the amount of insurance that we've actually spent, like the value that we spent, or can we go up to the actual value of the property itself?
That is an extremely good question. And the answer is it depends. So there's 2 different types of policy in the real estate investor world. One is a DP1 and one is a DP3. So on the DP3, that is a replacement cost policy. You don't have to cover it for replacement cost, but if you do not, when there is a claim, then there will be a coinsurance penalty attached to the claim. So
what does that actually mean, a coinsurance penalty? Can you give us for instance of what would actually happen?
Yes. And we can, if you guys have, it's kind of complicated, so I'm going to touch on it, but if you have specific questions, email me. But in a nutshell, it's how much, coinsurance is a percentage of the replacement cost. So if your policy has a coinsurance clause of 80%, so 80-20, then if you insure the property on a replacement on a DP3 for less than replacement cost, and if it's an 80-20 coinsurance clause and the carrier at claim time determines that you have insured the property for less than 80% of that coinsurance, there is a penalty, and then they will take that claim amount and reduce it accordingly to the same percentage as the 80%. So again, it gets kind of complicated, and I can send specific examples and break it down, the math and everything, but just look at it this way. Sometimes insurance or real estate investors want to only cover their interest in a property, which is understandable. Hey, I don't want to spend, they say the replacement cost is $200,000. I spent $30,000. There's no way I want to pay this premium on this property. That's fine. Just know that in the event of a claim, you'll have some coverage, but you're also going to be self-insuring to a degree. So really it's, do you want to pay more up front, or do you want to pay more at claim time? So it's kind of, look at it as, do I want to self-insure, and have kind of a bucket of money set aside for this coinsurance clause, later, but be saving money now? Or do I want to pay more now and then have a better settlement at claim time?
Right. Well, it is confusing because we buy these these contract for deed properties. The values are all over the map. Like
Yes.
They're low value for the most part houses to begin with. So, a lot of things can extremely affect their value, and it's hard to even assess the value because if you have realtors who only like to sell pretty houses, when you send them to look at one of these and give you a value, I had someone tell me a house I had in Indiana was only worth $10,000 because it was beat up. But we only put a little bit of fix-up money in it. We sold it for $49,900. So after putting $5,000 into it, so what was the value of that house? And how am I supposed to determine that?
That is actually a really good question too. So first,
I'm really racking them up here, Chris.
You are. No, but it's good. I mean, I haven't even gotten to my list except for number one.
Yes,
but first, the difference between a DP1 and a DP3, the DP1 policy allows you to cover a property for only what your interest is in it. So anyway, I just wanted to touch on that. But replacement cost, the way to determine it, it actually varies from area to area. Typically, the carriers that are doing this, that are national for real estate investors, will say you're safe if you figure roughly, the most recent figure I got was $100 per square foot. That being said, I will say that I had an investor in West Texas about a year ago, and I may have told you guys about this, but there was a hailstorm and 26 of his properties had to get new roofs.
Sounds like me with the trees in Indiana.
Well, get this. He went into it knowing the situation. He went into it knowing there would be a coinsurance penalty at the time if there was a claim, when there was a claim. So he was like, but I'm not paying replacement cost on these $20,000 bungalows I've got in, West Texas because, that's ridiculous. So he went into it knowing, and well aware of what he was doing. But of course, when 26 roofs had to be replaced, that coinsurance penalty did kick in. And after the deductible, he did have to pay, come out of pocket more than he would have otherwise. So anyway, replacement cost, it varies from area to area. To know specifically, you can contact a local agent. They've got access to Marshall Swift, and that will tell you exactly. But if you're pretty safe if you stick with $100. Oh, and where I was going with that, guess what the replacement cost for that guy in West Texas was? This little town, $117 a square foot. Isn't that insane? That's why he was like, no, I am not paying that kind of premium on these dumb houses. But anyway.
Yeah, well, I kind of famously, the very first contract for deed I ever bought, it was at the end of 2016, like literally last day of 2016, and on March 9th of the new year, that house burned down. And my first note experience.
Oh no!
Really crazy.
When it's not it's not can, it will. If it can happen, it will happen. It's
said like a true insurance person.
They pound that
from birth.
Yeah, from birth. Oh my gosh. Okay, I have to. Okay. The dog wanted out. Okay.
Oh, we all have dogs and small children, and
But
they're like a regular part of the show. Basically.
Yeah, good.
Bring them on.
Is there a price difference between a DP1 and DP3? Is one more expensive typically per 1,000 or per 100 than the other?
Yeah, and which one do we have if we just go onto your
I think I have a DP3.
and select force-placed insurance?
Yeah, I have DP3.
You do, yes, that is correct. So typically the rate per 100 is going to be exactly the same. The difference is, if you are doing replacement cost, obviously that rate per 100 is going to be much higher than if you're doing just your insurance, the amount of interest you have in the property. So 30,000 versus 120,000.
Mm-hmm.
You break that down, more. But the coverage is better on a DP3, just in general. Which brings me, one of my things I was going to talk about is, and this is super, super basic, but everybody needs to know it. What is the difference between a basic form policy and a special form policy? So have you guys heard of those two terms before?
No.
This is why it's important. So, and I will tell you, I've had people come to me because they had a real estate investor policy that they thought was everything they needed it to be. And then the claim happened and they found out they had a basic form policy with a hefty co-insurance clause and a high deductible. And when they had that tree fall through their roof, they got like $2,000 on a $20,000 claim. And they were not happy.
Mm.
So a basic form policy, and this is really important. It's fine to have one, but know that you have it. A basic form only insures for what is named, what is listed on the policy, and nothing else. And typically it's 5 basic perils, although some of them endorse for some more. The 5 basic perils are going to be fire, lightning, explosion, smoke, and windstorm. Sometimes they will add, hail, riot, there's vandalism, but anything outside of the things listed is not covered. So you can see where that would be very limited. It's basically a fire policy and that's it.
Right.
A special form policy or a broad form or all risk, it's all the same. Special, broad form, all risk. Those policies are just like they sound. They're special. They cover everything unless it's specifically excluded. So obviously that's going to be a much more comprehensive policy than, something that's only covering for what's listed. Because obviously there can be a whole lot outside of what's, those 5 or 10 or whatever they put on their perils. So that's a really important thing to know when you're shopping for insurance. Is this policy you're offering me, is it a basic form or is it a special form? Mm-hmm. If you get a quote from, Joe down the street and you're like, hey, Beth, this is, a third of the cost of what you're offering me. I'm going with him. Well, that's fine. Just know what you're buying. Know what your coverage is. So that way you don't end up with, paying for your new roof when you thought you had coverage. So that's something I think everybody needs to know. If you walk away from this with nothing else, walk away with knowing those 2 different types of forms of insurance policies.
Never heard of it.
Yeah, the other one I hear tossed around a lot, and this is what one question I asked you, is the claims made versus occurrence-based, type policy that you hear people talk about as well, because one of them kind of can be a gotcha, I think, as well, correct?
Yes, and truly they both can be gotchas, but one more so than the other. So a claims-made policy only will cover claims made during, just like it sounds, during the policy period. Anything that happened after that policy period ends, or if, let's say, the policy period ends and you find out that, a tree fell through the roof, my classic example, during that.
And mine.
And yours, yes. You're out of luck. With an occurrence policy, if you find out a tree fell through the roof during the previous policy's coverage period, potentially a claim can still be made going back to that policy. They'll still honor it even once the policy is no longer in effect.
Right. There's a time limit though for reporting it, isn't there?
Yes, and it depends from policy to policy. Some more so than others. I mean, I had a roof claim that I was able to go back 5 years on a house I owned. So it was a rental house. But
I wonder what prevents the policyholder from finding out for 5 years there was something like that.
Well, it was a rental, and I didn't know how bad it was. I had the next door neighbor who was a roofer. He was helping me supposedly, and anyway.
Oh, this was your property?
It was my property.
Oops.
I like to say it was a long time ago, but well, it kind of was. It was, yeah. My ex-husband died and left me a house.
Oh,
And
gosh.
yeah, anyway, it's a long story. You learn the hard way sometimes, but yes, I was able to get a new roof because my previous policy was occurrence. So
Wow.
it had been 5 years. That being said, there are some caveats. It's not cut and dry, even with the occurrence policy. For example, you have to have an insurable interest. So let's say you buy a property from Chris, and he has the policy, and it's an occurrence policy. And then you're the owner. Chris cannot make a claim on his insurance policy that was an occurrence policy if he no longer has an insurable interest in it. But there are, like so many other things, there are some ambiguities, especially in the real estate investor world. I know that there's a lot of private deals that go on. There's a lot of things, like Chris may still have his name on the deed, which then designates him having an insurable interest, even though you guys have signed some sort of contract that gives you some ownership in the property as well. In a case like that, he would have insurable interest and the claim could be made. Another example would be, let's say you had your property covered under a servicer and then you moved it over to J.B. Lloyd. Then the servicer's policy, because you were involved with both, the insurable interest would still be there. So we're at an occurrence policy, you would still be able to make a claim. Does that make sense? So
Yes.
it's not an across the board all the time. If Chris sells the property to you, his name has nothing to do with it anymore. You can't go make a claim on Chris's old policy. So anyway, I hope that makes sense.
Yeah, so we need to find out before we transfer it whether anything has happened that needs to be addressed.
Yes. And I will say, I'm working with another investor and an attorney on some language and verbiage for the contracts. It's so important to do your due diligence on these things. I know a lot of them are distressed, but to know what, if there's any pre-existing conditions. So you go in with your eyes wide open, and we're working with this attorney that will put some language in the contract that will hopefully hold the sellers accountable if they're selling something knowing there is some pre-existing conditions. So
that's
I will keep you posted on
I can't wait to see that.
Yeah, and
I'll keep you posted. She thinks
tell her to sign it.
They are the sneakiest people alive. It's so funny. I'm actually selling a house right now in Birmingham. I put it up for sale for $500 on Facebook Live. Facebook Marketplace, because it's a terrible house. And the headline says, "This house totally sucks, and that's why I'm selling it for less than the price of an iPhone."
Oh my gosh! Did anybody buy it?
I have many interested parties.
Well, yeah. Just be sure you say as is.
Totally.
As is.
Yes.
I'm giving it to you as is. So. Yes. Anyway, yeah. So those are some fun insurance things. Let me see what else I had on here.
Well, let me just interrupt you to say that you have like the best portal for, the ability to add your own coverages, add your own properties, change coverages, cancel policies. It's genius. And it probably keeps people from bothering you too, which is, so you love it as well.
Thank you. Thank you. We try. My dad
awesome.
said when we put it together, it had to be gym proof, basically, because he's very non-technical, and he said he had to be able to work it. So that's been our litmus test.
Seems very gym proof to me.
Yeah.
But I'm curious, like if I'm going on there and putting forced place insurance on things, like do I have DP1 or DP3, or is that not where it gets established?
Well, again, it depends on yours. I want to say because we're changing you up, but your original policy was an actual traditional forced place policy. which we sometimes do. Sometimes with real estate investors, we do. So, then when you and I originally talked, the real estate investor form was not as evolved as it has become since then. It's been, what, 2 years, 3 years?
Mm-hmm.
So, yeah, you have a traditional forced place policy, which has its pros and has its cons. Yeah, you do have very good coverage. I'll tell you that.
Maybe I shouldn't mess with it. And as my rates are going up, now that I used to have like a whole bunch of properties under one entity name, and now that I'm chunking them out into like smaller things, like my rates went from $1 per 100 to $1.15.
Oh, so she did go up. I didn't check. I thought they may have gone up, but I didn't go back and look because I was busy today. But if let's talk afterwards or tomorrow and look at what the differences are, and you can make the call on it.
Yeah. Okay. Sounds great.
Okay. So
what kind of insurance is good for landlord? Oh, it went away. There was a question.
Yeah, there's a few questions I'll ask you that came through. Is so what kind of insurance is good for landlords with rentals? Was one question.
Okay, so the real estate investor policy works very well for landlords with rentals. The one thing I would say, you can add loss of rents to it, and that's always good. Some lenders of real estate investors actually require loss of rents. So, but the master policy is actually a very good policy for that. It allows the investor that is a landlord to manage the insurance on multiple properties in one place.
Okay. Another question came through is, what if the value of the home is less than the UPB? So the house is worth $50,000, unpaid principal balance is $100,000, and it burns down. As a claim based on the amount of the replacement costs, or the the property value, or the UPB, the unpaid balance. So if somebody owes $100,000 on their mortgage, property's only worth $50,000. How's that work in those situations?
Okay, so that actually that's the financial considerations, but they're connected, but that's not the insurance. So with insurance, it doesn't matter what the unpaid balance is, and it doesn't matter what the property is worth. What matters is what it would cost to rebuild the property. So let's say in that example, the unpaid balance is $100,000. The property is worth on the market $50,000. But because the property is 100 square feet, or I'm sorry, not 100, 1,000 square feet, the replacement cost is $100,000. And so if you're using replacement cost and you insure that property for $100,000 at the time of a claim, then after the deductible, you will get full replacement cost. So basically, you're going to come out even. But a better example might be, let's say the unpaid balance is $150,000. And let's say the property is worth $50,000, but the replacement cost is $100,000. Well, at the time of a total loss, then you'd basically be out the deductible, which could be, let's just use $2,500 as an example, but you'd also be out that $50,000 of unpaid balance, and you'd be upside down. So, insurance isn't a tool to recoup your investment. It's to protect your interests. And if that makes any sense, it's different. It's you're not supposed to profit from insurance. You're supposed to be made whole.
Mm-hmm. So if, say, something like, Gail had a house burns down and you had it insured for $100,000, you collect $100,000. Do you have to rebuild that house for the borrower, or can you just say, hey, look, I'm taking my money from the insurance claim and see you later? I mean, what is there? That's a question for you, an attorney, but what rights does the borrower have that they didn't have their own insurance? So you have the insurance covering really you asset in the property, but do I have to go back and build that home for that borrower again? Do you know?
That's a good question. So in that case, it depends. Again, that's another famous line in insurance. Some of our policies have specific language that if you do not repair or replace the damage within 90 days, or some of them have a other specified number of days, 90 is the one that's coming to mind, that's on the Great American policy, then the claim amount is reduced, or the settlement amount is reduced from a replacement cost settlement to an actual cash value settlement, which that was actually on my list to go over those terms, so I'll go over them now. Replacement costs, the cost to rebuild. Actual cash value, or ACV, is you take the replacement cost, you deduct depreciation, and that would be the amount less the deductible and any coinsurance. So that can obviously hit hard. So in a case like this, let's say the investor doesn't want to rebuild, he just wants to take the money and run. With some of the policies, that's fine. He would just get a lesser settlement than he would have otherwise. On some of the other policies we have, it wouldn't matter. It would just be replacement costs. There would be no penalty for not rebuilding. Now, that being said, as the policy holder, the real estate investor has no obligation to the tenant or their borrower unless they have some other type of legal arrangement with that person. We have the ability, we have a program, and I know some other insurers do as well, that will allow homeowners that perhaps are not on the deed. So like a person who's involved with a contract for deed, they're in the house, but you as the investor have the deed. There's a program that will get them their own insurance. And that's really going to be in the best interest of the borrower, tenant, or whatever, is to have their own policy, whether it's a tenant liability or renter's insurance policy, or a homeowner's policy that's suited to them and their particular arrangement. Because you guys don't have the obligation. You don't have to rebuild. You don't have to replace their stuff. You know, you guys are the named insured. The check is being written to you.
Yeah, that's interesting. So in the case of my house that burned down, I hadn't really even connected with the borrower enough to know whether they had their own insurance. So I had my own insurance, and it turned out that they did have their own insurance.
Oh, thank goodness, right?
So the first thing is that you can't really collect on two policies, right? It's not like life insurance where you can have multiple policies. I assume that maybe like the second policy would it have filled in any gaps, or there was nothing that I could get from the second policy?
No, if they had their own insurance policy, that would be primary. That would be the one that kicked in. If they have their own, then yours would not kick in.
Right.
That.
Now, in fact, it did not.
Right. Now, if they're a tenant, though, and they have renter's insurance, then yours would still kick in. Right. Theirs would only cover the contents.
You know, the other thing that was really weird, and this was, again, it was very interesting because I was a new note investor. So, of course, I went to the most experienced people that I knew in the business. And it's really surprising and probably good, like how few people experience a fire in their lifetime. I mean, even owning a lot of houses. So that's good.
That's good.
But the thing that was like really weird about it is that because it was the contract for deed borrower's policy, I was very surprised that the insurance company was going to give all the money to the borrower, and I was going to have to like chase them for it. Yeah, that was like the thing. That's what they said. And my servicer initially was sort of talking to the insurance company to say like, hey, let's send separate checks. You send us a check for the balance. You send her the check for the remainder. And that was not what they did. Like it turned into sort of a very kind of a big cliffhanger about whether I would have to chase her for the money.
Oh my gosh. Yeah, there's some gray area there with the whole contract for deed thing, because if the borrower has the insurance, even though they're not on the deed, but they decide to take the money and run, then the investor's out. So I mean, you got a whole, I don't know. I mean, that would be a legal question. I don't even know if I could answer that, because at some point you would hope that your coverage would kick in if they did do that. But I can't answer. I don't know.
Yeah, I mean, I was lucky that she agreed to let them pay me separately.
Yes, no kidding. Yeah. Oh, wow. I can pull up these questions. I'm sorry. I'm very new to this.
Yeah, that's quite all right. I'm providing some dog in the background, dog noise, so you'll feel right at home.
Somebody
and hi, Cody. I see Cody Cox is on here.
Yeah.
I know you.
Somebody asked a question if there's a minimum requirement to work with J.B. Lloyd. They said there's a rumor that you must have 4 properties to insure before we can work with you.
Well, no. I mean, we can still work together if you have fewer than that. It's just not always worth the investor's time. It's 3 or 4, kind of depending on the values of the properties. Sometimes the underwriters like to see 5 if they're all very low valued properties. There's kind of, the underwriters want to see there's going to be a basis for premium that, to offset the risk of the policy. That being said, we have access to a carrier who will do one-off type of properties. And it's pretty good. The thing is, the premiums tend to be a little high. I say this, if an investor, they're just starting out, they just have 1 or 2, if the first thing they should probably do in that case is go to their local agent and see if they can get some just quick coverage that's reasonable. And then when they build it up to a place where they've got 3 to 5, again, depending on the values, then we can talk. If they can't get coverage through their local agent, we can get it for them. It's not the master policy. The premium's a little high. Sometimes the coverage is not as great. It's better than nothing, but so we can help them. It's not my preference, and I don't obviously think it's in the best interest of the investor.
Right. So when you say, depending on the value of the house, do you have in your mind like a dollar amount of how much house you need in whatever number of properties?
I don't, and I gotta say, I don't think that the underwriters have a very consistent view of that either, because I have found no consistency in it. Sometimes I think it kind of depends on where they are, how busy they are. They've got a lot coming in, they get a little more picky. If they don't, they're like, oh yeah, 2 of them that are valued at $50,000 each. We've got this. We'll give you the best rates. So yeah,
Yeah, 50,000 is a very nice contract for deed house.
Yes, it is. I thought about that when I said, I was like, oh yeah.
What I usually tell people is on their first note, and they've got so much going on, is just get the insurance with your servicer for the time being, because they've got so much. And it, like I said, to get the policy through you and all the paperwork and everything, if you just tell the servicer, hey, put this under insurance for this much, and let them know whether it's a contract for deed or not, so it has a liability component to it. Not take business away from you, but I think,
no, I think you're wise. I like that. I love business and I love working with people, but I want to be able to work with people fairly and give them the best product for a fair price. And I don't want to, I think it's better to educate and say, okay, well, this is what we have available. This is, when you get to this place with it, it's going to make the most sense for you. And this is how it will work at that time.
Right.
Okay. Is there other things you wanted to, I know you still got your list, and we got a few questions, but I know there's certain things I think would be priority for you to cover if there's other things you wanted to.
I had on here flood. Just to quickly address flood, we have problems with that, especially in Texas, California, and a few other areas. We can add that to policies, which it's all a part of the portal. It's a separate policy, but it's seamless. So you just log in, add it, pick the flood option, and go from there. That
Right,
means,
so you have to like go find like a flood map and see what zone you're actually in, right? What kind of a...
right, to know if it's going to be covered. Our flood policy is covered at the national flood rates. It's good for a stopgap, get the coverage, but sometimes you're going to find better premiums doing just individual flood policies. So say you get a property tomorrow, you realize it's in a floodplain, you need that coverage immediately. Great, put it on the online system, you've got that coverage, and then go shop and find a better deal. So that's kind of my standard advice on flood.
Yeah, and now we were talking about this. So you didn't used to have that as a self-selecting on your portal, and now you've added it, which is great. But one of the things that you do ask in a drop-down box, like what flood zone it is, and do the rates actually vary according to like how high risk, or is it just flood?
It varies according to the flood zone.
Okay.
On the flood map. They're the national flood rates according to what flood zone they're in. So we don't actually make the determination of what those rates are. They're told to us. But again, private flood insurance can be a lot more affordable.
Well, I attempted to sign up for flood insurance in X zone, which is not flood risk, and it kept coming back as my policy, like my premium was 0. And I thought, oh, is that, are you telling me?
I like that.
Thank you for the free flood insurance.
You're welcome. We aim to please.
I'm very happy.
So, okay, there was a rumor circling around that in the NICS community last year that an investor had to have at least 4 properties. We talked about that. Yeah, that's
not a rumor, as it turns out.
Yeah, it's a moving target, but yeah, around 4.
One question that came up was about buying a partial and if they needed insurance. And that one, I would say you got to usually on partials, and it depends who you're buying them from, but check your contract, because usually the person who's managing them still should be responsible for the insurance on them. You shouldn't have to get a separate policy. That's something you would want to check your contract and stuff. I know when I sell partials to somebody, I am the one who manages and holds the insurance. So basically that investor doesn't have any insurance requirement or anything additional in that sense.
You can also, like if, let's say you sell a partial, you can add the person who you're selling it to as an additional mortgagee on that specific property on the online system, so that, and then print them a person, and they're actually having an interest in just that property, but not the entire policy and not all the properties that are on the policy. Similar to how you would if you had a lender.
Making that note right now.
Yes. I filled a sheet here, so I'm writing and writing.
2 other questions came up through the Q&A. One is, do you write policies in fire brush zones?
And what are they?
Like a
fire brush?
Basically wildfire zone, I'm guessing?
Oh, yes, we do.
Okay.
Yeah, in fact, I do with my banks. I do a whole lot of work in California. So I got to be there during the car fire in Redding. I was in Redding during the car fire last year. I was in Chico the day before the fire last fall. But yeah, we do.
Wow.
Quick question came through is, if there's less than 10 properties, is there a setup fee or?
No. Okay. There is a policy fee that covers the cost of filing the policy in the state in which the investor is domiciled. Okay. But there's not a setup fee.
And this one's I think a brain teaser question. 3. He foreclosed on a non-owner occupied property from a second position. There's a tenant who's in there that the lease expires in November of 2020, so it's got a year and a half. He did not pay off the first when he foreclosed. So he becomes a landlord, paying the insurance premium that the borrower purchased every month as part of the escrow. So how does he add his entity as insured to the current policy, or does he take a new policy and inform the senior lien holder? So for what it sounds like is he foreclosed, he took over the first mortgage. The first mortgage probably has an insurance policy covering the place, but he wants to insure his rights, I think is what he's looking to do.
It sounds like the insurance policy that is in place does not have him listed as a named insured. Is that correct?
Yeah, and he wants to know how he can get named.
Okay. So the named insured would have to contact his insurance or her insurance company that has that insurance policy on that property and add him as an additional named insured. Or cancel that policy, and then he needs to get his own policy. So it would be one or the other.
And you probably have to name the first position lien holder as an additional insured, I'm guessing.
Correct.
Okay.
Yeah, that was.
Yeah. And then he said, what if the borrower doesn't cooperate? How much? Oh. Well, didn't you?
That's why we're here.
Yeah. He said, I foreclosed on her. What right? It doesn't matter if she cooperates or not, I'm guessing, because you foreclosed on her.
Right. And that's when you get the attorneys involved. I know, Gail, you've had to go kick people out of houses before. I remember.
Yeah.
I think I talked to you when you were going into one or in one or something.
Okay, let's see. I think. Okay. So. And then.
Oh, go ahead. I'm sorry.
He then asked, how can he get a policy number and carrier info?
From the first lien holder?
Yeah, from the first one.
I mean, I was assuming there would be a relationship and communication there.
Yeah, it's got to be negotiated, right?
He asked if he could hop on. I don't have a problem bringing him on. Is it okay? Let's see here. While I'm bringing him on, Sylvia asked the question, how much should the borrower be insured for the value of the collateral or the loan amount? What percentage of the insured amount is paid out in case of fire or flood? I think we kind of covered that in the sense of you really should protect your interest and value the property, and the borrower really isn't the one being insured.
Right.
Yeah, I have to say, the first time a tree crashed through a roof of mine, I was not aware of the depreciation deduction. That was a little tough.
Yes. Yeah. It's not a good surprise.
Yeah.
Can you guys hear me?
Yes, we can.
Hi, Chris. Hi, Gail. How are you guys?
How are you?
I'm good. So this property is in Connecticut. I foreclosed from the second position. What I don't know is, should I get the insurance information, like the policy number and the agent number, the phone number to call from the senior lien lender, or how do I go about it?
Are you talking about getting the policy information from the first lien holder?
I'm asking, is that what I should be doing?
Okay, so you would need, if you're not a named insured, even if you have the policy information and you call them, they cannot talk to you.
Okay.
So you need to speak to the named insured. So if you can get that person's contact information, that's who you need to talk to.
I have the information. So what happened is when I foreclosed, the borrower didn't respond. I don't have the number. The tenant gave me the landlord's name, previous landlord's name and number. So I'm going to call them. Probably it's going to be a cash for keys kind of thing, cash for insurance information, I guess. Because I foreclosed on her and took the property from her. So getting the insurance information, they don't have any incentive to disclose that info right now.
So is the borrower the one who's the named insured?
Yes.
Okay. Then in this case, that's a tradition. This would be a case where you would be able to, if you had a forced place policy or a real estate investor policy, you would then send them a letter saying, I need to be added as a named insured on your policy, and I need proof of this by this date.
So
Yeah.
I need to call a different insurance agent and basically tell them that I want to buy a force-based insurance. And,
Yes.
Okay. And if a claim were to be filed, wouldn't the two insurance companies be fighting against each other? Like who needs to pay what?
No, because as long as you've sent her the letters that state what you're doing, if she doesn't comply with the requirements, which are that she adds you as as basically the lender on the policy, so additional mortgagee, then you're going to force place coverage on her, and then you give her a time frame. It's typically 30 days, and then after 30 days, you then send another letter. You've got 2 weeks. At the end of that 2 weeks, if it doesn't happen, then you can force legally, and you would be the primary because she did not comply with the insurance requirements as stated in the contract.
Perfect. Okay. Thank you.
You have copies of those letters too, because those are like CFPB type letters, aren't they?
Yeah.
Yeah. Did I send them to you guys? I know I sent them to you, Gail.
I've used them many, many times.
Can you send them to me, Gail or Chris? One of them. I'll send you an email.
Yep.
Thank you.
Yep.
Thanks, Sri.
Yes, that's true too. I mean, Sri's talking about a situation where he foreclosed, but really any borrower, when you first take over a loan and demand proof of insurance, if they don't give it to you, you send these letters because as soon as you do the required 2 letters 30 days apart, then you'll be able to add the cost of your forced place insurance to their loan. So, I mean, it's kind of, it's a beautiful dream that you will get that money back. I mean, in most cases, more and more I'm seeing that we get these houses back and there's never any reimbursement for the insurance, but oh well.
Right. But, you have to go through the steps, right, of the regulations and, inform them, give them fair warning that this is what you're requiring. This is what's going to happen if you don't get it. And that pertains to proof of coverage that they should send you. It pertains to adding you as the lender as an additional mortgagee. It can pertain to the AM Best rating of the insurance carrier. You can say, okay, I will not accept insurance from anything less than a B rated carrier. It also can pertain to the limits. You can require limits. You can say, just like the insurance companies do, to your borrower, I need you to have at least 80% of replacement costs with this deductible, da, 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 da. So, I mean, you can put all that in there. And if they don't follow any of those things, you can force.
Yeah, they just ignore us, Beth.
I know.
We're just gnats buzzing around their heads.
Well,
I found it very.
Sometimes they think that they are covered. They are covered because you have coverage. When you send them hey, this is what I.
Yeah, they're like, great, thanks.
Thanks. My lender got me coverage. The lender got themselves.
Those letters very specifically say that what we have is probably not going to be that helpful to you, and
right.
You could get better coverage at a better price yourself if you went for it, which I don't know if they could.
Beth, you have a portal that someone can go on, a borrower can go on and apply for insurance, correct?
Yes. That was what I was referring to for those homeowners that may not be on the deed, but yet they're homeowners in the contract for deed situation.
Mm-hmm.
So you mean as long as they have to be borrowers of ours, or any borrowers can go onto your portal?
It's a homeowner's policy for anybody who has a hard time getting homeowner's insurance.
Oh, wow.
It's cool. It came about prior to the financial collapse, back when you could have a 400 credit score, FICO score, and still get a stated income only mortgage for $700,000.
We call that the good old days in real estate.
I worked with a lot of mortgage brokers back then with this program because they could qualify anybody, but those same borrowers could not get insurance because their credit score was so bad. So we got.
Somebody still had standards, you're saying.
Yeah, it was like 1929. These conferences we'd go to, the champagne was flowing. I got to meet Troy Aikman. It was like, woohoo!
Yeah.
And then boom.
Mountains of Coke, I bet, right?
Yeah, it was a big change. So, anyway, yeah, I think I covered everything that I had on my list. Oh, one thing I was going to address, and I think we really did, was how to handle REOs. And really, on a real estate investor policy, it's no different than handling any other property you have an interest in, because the liability is there. Now, Gail, on yours is a forced place policy. So on yours, you just need to be very cognizant that you change the status when you go into foreclosure, because you want to be sure that liability gets added.
Yes, I better go check all my things. The other thing that I was going to ask you, so when we get houses back, they become REOs, then lots of times we're like renovating too. Is there like a builder's risk that we should transition into, and like how does that get arranged?
You're going to love my answer to this. It depends. It depends on your policy.
I can now play Beth on TV because I can say it depends.
And it's not if, it's when. My 2 words. So it depends on your policy. Some of my carriers have builder's risk built into the policy. So you don't have to do anything. It's covered. It's there. Some others, we can add it as a separate kind of like flood. So it's just an additional policy. You don't actually see any difference. You just have an additional option on the drop down for builder's risk. So it just depends on your policy. So I'd have to check on yours, Gail. I think we may have added it to yours because yours is not built in, but I think we did add it. So I'll make a note and check that and make sure.
I'm glad I'm getting a lot of like personal help on this. So thank you very much. Thank you all for helping.
One thing though, I'm sorry to interrupt, but just note, if it's more than 80% complete, it's not considered builder's risk. It's just.
Well, that's what I was going to ask you. Like, how much do you have to be doing to need builder's risk? Like, how much renovation? Like, I assume painting does not require builder's risk. But how about ripping out a kitchen and putting in new cabinets and stuff? Is that a builder's risk situation?
It depends. So they look at it this way: anything less than 80% completion is builder's risk. So a kitchen remodel may or may not be, but if you're going in and going to the studs throughout the entire property, that would be builder's risk. Gutting it, so just think that 80%, and you're pretty safe as long as you're kind of looking at it that way.
I'm going to send you some really scary pictures of a construction I'm doing.
Am I going to scream and say it's all builder's risk?
There isn't even a level for this one. I've exceeded every level you have.
Going pioneer on me.
Yeah, there is a little
question I had, Beth, is, if we take back properties as an REO and just keep them as rentals and stuff, we can just keep the policy with you, correct? If it's an investor policy?
Yes. Okay. In fact, some real estate investors have nothing but rentals and use this policy. Mm-hmm. So I would just say, you be aware that if you don't add loss of rents and you're doing a rental, then if the house burns down and you have no tenant in there while you're completing the repairs or rebuilding, unless you have covered it for loss of rents, you will be out that income during the time that there's no tenant there. So consider loss of rents in that situation, or if you're not going to do it, just be aware that you'll be out that income.
Oops.
So someone was just saying, like, what if there are 2 policies? Going back to Sri's question, like there's an existing policy and then you take out a policy. Karen, I'm not sure, like, what is your question? What if you have 2 policies?
I think it's question of if the first mortgage has a policy, can the second get a policy as well to cover their interests, or are they covered by, if they're not additional insured on the first and the person's not paying, should they in the second position also have a lender placed, force placed, or their own investor insurance on a property?
They could. If the first position person is not covering them and that agreement has not been made between the two parties, then the second lien holder could put like a DP1 policy where they're only covering their interest in the policy or in the property.
Okay. So if they owed you 20 grand, you could get a DP1 for that 20 grand balance or something.
Exactly.
Okay.
So Nahid is asking if the insurance that covers rents can be added on to her regular insurance.
Yes. So we call it loss of rents. Renter's insurance is actually what would cover a person that was renting, so the tenant.
Yeah, their belongings.
Right. So loss of rents can be added to a landlord policy, and that would kick in after 30 days after the loss and cover the amount of rent that is what they would normally get for up to 12 months. Or during the time of repairs if it were less than 12 months.
Okay, so I think we've answered everybody's question. If there's someone whose question we have not answered, can you raise your hand now?
Speak up or forever hold your peace.
What's that?
Speak up or forever hold your peace.
That's right. This is it. You'll never see her again.
No, never. I'll go back in my cave.
Beth, if people want to reach out and contact you to get stuff set up, do you mind giving people your contact information? And we'll put it in the show notes as well.
I like Kent's. Yes. My cell phone is 972-342-4280. And my email address is y'all are going to hate this, E like Elizabeth, Boisseau, which is B as in boy, O like Oscar, I like ice cream, S like Sam, S like Sam, E like egg, A like apple, U like umbrella. So E Boisseau at Lloyd with 2 L's -ins.com. So if you guys think of any questions that we didn't cover, you wake up at 10 in the morning with this burning desire to know more about replacement cost or insurance, please email me. Don't call, email me.
Yes.
You can call me after 7 a.m. Not at 2 a.m.
Central time.
Central time, right.
Central time, yes.
Yeah.
No, so if you think of any other questions, I'm happy to answer them, and feel free to reach out. And you don't have to be a client to do that. I'm happy to help. So.
Question did pop up for force place insurance. Is it true it needs to be monitored weekly?
No.
That sounds like a lot.
Yeah. Only if there's changes.
Mm-hmm. Okay.
So if you have a change in your, the amount you want coverage, or a change in the occupancy, or the change in the status, you can go online. But no, as long as it's on there, it's on there. Mm-hmm. It doesn't go off until you take it off.
Well, this has been a very information-packed session. I would say, my takeaway from this is that I think as things happen, I'm going to keep needing to ask you very, situational questions for probably a couple more years until I feel like I really get my arms around this subject. I'm the only one I'm a slow learner when it comes to insurance.
I think you do great. I really do.
Yeah. 2 things I'll comment on is, to understand the insurance. And once you get a certain size loans, I recommend going to a company like J.B. Lloyd, because when you're using a servicer, when you have to file a claim, it's a pain. Trust me, I know. And you're dealing with the servicer and the insurance, and there's a lot of miscommunication. One of the things that I really like about J.B. Lloyd is the fact that how simple it is to add and remove loans. And with other carriers, sometimes you have to fill out a form, send in the check for the year, and then when you sell the loan 4 months later, you have to email them or send them a letter that then they'll mail you the refund and things like that, where here you can just pay everything on a monthly basis. You can go in and actually have a portal to see what's insured and what's not. So if there's a question of, oh, did I insure that property or not? You can usually go look. Put in the system. You can then, right when it's put in, you can print out the declaration page or whatever it's called, send it to your servicer so they have it, so they can start collecting the escrow and start sending you the money back. So it's just, again, I'm an automation guy, so
he's a control freak too.
Oh, yeah, control freak too.
You are like crack to him, Beth.
Yeah. Oh, when I saw that photo, I was like, remember one time I'm texting Beth, I'm like, I lost my password.
I'm curious about something. I don't know, this just occurred to me because I'm like tired now, and I should be putting in a whole bunch of properties before I go to sleep, and I don't want to. Like, you always let people go back. Like, I could put them in tomorrow, effective today, right?
Correct.
And then, but how far back do you let people go? I mean, as long as there hasn't been a disaster, you don't really care, or?
You can go back to the policy inception. Well, if you're in this policy period, you could go back. Let's say your renewal date is January. You can go back as far as January. But if you go back that far, Misty is going to have to go in and click her little button to get it out of pending status. And
okay, cool.
Yeah.
Well, thank you so much, Beth. You are
thanks for having me.
You are the queen of insurance. It's amazing. It's almost like you were born to it.
I know. It's amazing. Yeah. I got used to this stuff growing up, and I'd be just so bored. Now boring everybody else. Sorry, guys.
You're that family that never gets invited anywhere.
That's so true. It's like, oh, don't invite them. They just talk about insurance all the time.
Yeah, it's funny. My father's a doctor and my mother's a nurse. And honestly, I could do surgery on people at this point just from the dinner conversations growing up. So I know how that is. I really
have no qualms about blood either.
Well, no, it's disgusting. And that's why I went a completely different way.
You did. Yes, you did. I have certainly enjoyed this, and I appreciate y'all having me on here. And if anybody thinks of anything, please let me know. And Cody, it's good to see you, even if I'm not seeing you. I'm just seeing your words there. So anyway, but it's been fun.
Right. Are you going to any of the note conferences that are coming up?
I am going to Dallas,
right.
November.
You like to stay local.
Well, I did a ton of bank conferences here this year, and I do typically.
Yeah, every time I call you, you're in Hawaii or something and not enjoying yourself, just like working.
Working, yes, every year. Yeah, I just got back. Really, I just landed from 3 months of solid travel. No, 4. It started in February. So yeah, but I've been doing more banks. Next year, I'm going to try to do more real estate investor. I've been getting texts from people saying, Beth, you're slacking. You need to.
They're a demanding bunch.
Yeah, they're sending. Actually, I just got one last week from a guy in California that I'm friends with. He's an investor, and he's like, Beth, you're slacking. David's getting mad at you. So I don't know if y'all know David, but anyway, if you meet him, you'll never forget him. I'll tell you that.
Exactly.
Such rude people, investors. Thanks again so much, Beth, and thank you everyone for joining us. Be sure to tune in to our regular podcast. Chris, did you have any closing thoughts? You say night-night?
No, I think, we covered a lot of great content tonight, and I think it's, one of the things that nobody likes insurance, and it's kind of like one of those things like, oh, it's like filing.
No, Beth likes insurance.
Nobody likes, no investors, but it's a necessary evil. And, when people are sitting there trying to evaluate what they're going to insure properties for, don't go cheap, insure it for what it's worth, because a lot of times, again, it's getting charged back to the borrower. So, and on non-performing notes, it's the cost of doing business. So you definitely want to make sure you protect your interest, because especially if you're using other people's money, that's what I just want to end with.
Amen.
Points to ponder. Great. Well, thanks so much. Thanks for joining us. And
Great evening. Thank you for having me.
sure thing. Everyone go out and do some good deeds. We'll see you on the next one.
Thank you.
Bye now.
Bye.